demais!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, where earnings is the season, but don't let that be the reason to lose that long-term attitude and sell on the back of CEOs' platitudes. We break down the world of investing from beginning to dividends so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. I think we're going to have a full rap verse by the end of the year.
It's getting too long, isn't it?
No such thing as too long. I'm liking it. I think there's always a nice surprise at the front of the episode for me.
Well, that one, as you can tell, Ren, that was all about earnings season, and that's what we're going to focus on today in our episode over the last couple of weeks. Yeah,
you've set the bar high now that you're doing thematic intros. The last two episodes, they've related to the episode, so that's added another layer of challenge for you.
That's true. I'm digging myself a hole. I really need to revert back to the old school way of doing things. Far too much time and energy is going into thinking about these things.
No, it's good. It's good. Keep it going. Keep it going.
So, big win for Essendon last night, which is good. We've now hopefully locked ourselves into the finals. Swans also had a good win on the weekend, so It's been a positive weekend for us.
Lock us in for the 2020 finals.
Yep, lock you in. You guys, I don't know if the win would have helped your idea of getting a good draft pick this year, but nonetheless, they got the job done.
That's all right. We'll be right. Youngest team in the league at the moment.
Really?
Yeah. No one picks it, but yeah, we're rebuilding on the fly.
A long while. Anyway, Ren, so reporting season, I guess it's an exciting time of the year for many investors. As we alluded to in the intro there, sometimes investors use this as a part of their strategy to try and, I guess, pick stocks that are either going to underperform against analyst estimates or outperform against analyst estimates and try to make use of the gains or losses that follow that. But Ren, for you and I, it's merely an opportunity for us to check in with some of the companies that we've been following, and I guess we don't really use it as a time to buy and sell off the back of the reports that are coming out. We know it's often an emotional time for many investors, and the reactions that come as a result of some of the reporting can be overinflated. So we're going to, I guess, choose a couple of stocks that have piqued our interest over the last couple of weeks on the ASX. Maybe we'll touch on some in the US as well, and just get a bit of an insight into how they reported, and we'll go from there. What are your thoughts?
And I think it's worth just clarifying, earnings season is, in Australia at this time, most companies' full year reports, because they run a financial year, July to June. And then for some companies that run calendar years, they still report at this time, but it's only their half year earnings. But in Australia, most companies, we get annual reports in this period, in the August and September period, and then we get half year February and March.
Nice, yeah. So do you want to kick it off, Ren?
Yeah, so I thought we'd start with our stock of the year bets. You
Nice.
are absolutely smoking me for the second year in a row in this. It's not good for me, but my pick, Costa Group, haven't reported yet. They report on the 23rd of August. So I guess I'm spared some pain in that respect. Your company, Baby Bunting, has reported, and I don't think you've seen it yet. Is that right?
No.
Okay, so I get to break the news for you.
Awesome.
Company halved in value on the back of a $200 million loss.
What?
No, I'm kidding.
I was going to say, Jesus.
The company was actually up 13% post-announcement. Key highlights: revenue up 21%, same-store sales, comp sales, up 8.7%, net profit up 43%, and the dividend they're paying up 59%. So some really good numbers, especially for a bricks and mortar retailer there.
No, that's great, and somewhat expected, I guess, knowing the opportunity they have to really monopolise their their niche in the market. So good to see that they're putting that opportunity to good use.
Yeah, a couple
Go
of
Baby Bunting.
things surprised me. So, how many stores do you reckon Baby Bunting has?
I should know this considering it's my stock of the year, but I'm going to say I reckon they've got about 50.
Yeah, they've got 53. I guess that makes sense, but I just thought they would be bigger than that, given they're, the only... Well, they were the biggest specialty baby retailer, and now they're the only one left standing, really. But yeah, 53 stores. And when we talk about all their competitors that have closed down, it's 70 competitor shops have closed. So, I mean, I guess we come from a world of retail where we're talking hundreds or thousands of sites rather than tens. So that surprised me.
And I guess the question is, are they pushing for more brick and mortar? My understanding was that they were looking to push their online side of things more, so perhaps it's not as important for them.
Yeah, well, I think every retailer these days has to say that in their annual report.
True.
I think I read their online sales penetration was up to 11%. So 11% of their sales were coming from online. The problem for retailers, and this is a whole separate episode, is that how many of the sales they're making online are actually profitable, and how much of them are just to try and protect market share and they're losing money on it.
Yeah. Nice. Well, Go Baby Bunting. Looking forward to seeing how it starts the start of this financial year. I think going into Christmas should hopefully be good for them. And I'm looking forward to Costa, Ren. So that was your pick of the year for our challenge. And I know recently they did release a profit warning, didn't they?
Yeah, that's it. We don't have to dwell on this one too much.
So see what comes of them. So when is it? Next week?
23rd of August, yeah.
Nice.
So do you want to hit us with a company that you've been looking at?
Yeah, sure. This one should be well known to most Australian investors. It's an absolute champion of the Australian stock market, and that is CSL, Ren. Nothing exciting about this company, but when I saw its results and its stock price movement and its current stock price, I thought it was worth just quickly giving it a shout out, because I remember back only a few years ago, the race to the $100 mark was between CSL and Macquarie Bank, and CBA was sort of getting there at some point in time, and CSL hit 100, as did Macquarie. But now CSL shares are at an all-time high of $235.66, and that's on the back of their results. They're up 25% this year, Ren. So this company just keeps on performing. They're a biotech company, and they reported an 11% rise in net profit after tax to just shy of $2 billion. But when you take into consideration the impact on exchange rates, if you bring that back to Australia, that's actually an increase of 17%. So they're really growing. It's on the back of growth in their plasma business, doing really well for them. They're a global company all through Europe and North America, providing a lot of, I guess, biotech products. So they just keep on pumping out. They expect growth to continue as well.
Yeah.
So, yeah, massive company.
An unbelievable Australian success story, and probably the best example of government privatisation leading to world-class private company.
Yeah, it's nuts. So that's for the big one. I might just continue with the Australian theme, Ren.
Yeah, go for it.
The other one that really surprised me, and I guess surprised the market as well, was JB Hi-Fi. Now, we know that the retail sector at the moment, very competitive. Also, economy, generally speaking, is slowing down somewhat. So it's these sorts of businesses that tend to suffer a little when it comes to that sort of discretionary spend from consumers. However, JB Hi-Fi just continues to perform well. They reported record sales and earnings for the end of this year, 2019. Sales lifted 3.5% to $7.1 billion, which did meet analyst expectations, Ren, and we know that is a positive thing when it comes to earnings announcements. If you don't meet analyst expectations, then your share price can generally suffer. But because of that, their share price actually jumped 8% following the announcement. So they've performed really well. The Good Guys, who are owned by JB Hi-Fi, contributed 30% of total sales over that period, up 2.5%. So an interesting little fact there. I think from an outlook point of view, JB Hi-Fi anticipate that roughly to a $7.5 billion, or 2% higher over FY19. So sales look to be on a strong trajectory. I guess watch this space given the state of the economy. So they've performed well.
Yeah. You say it's surprising, and you're not alone in saying that. JB Hi-Fi is one of the highest shorted stocks in Australia. I'm actually just not that surprised. Everyone's thesis is that retail is suffering and JB Hi-Fi are ripe for disruption from Amazon because what they sell is CDs and DVDs and stuff like that. But JB Hi-Fi continually outperforms expectations, and they're not the cheap CD retailer anymore. They sell a lot of sort of high-touch electronics, your TVs, your phones and stuff like that. But they're just an exceptionally well-run business, and I think what we've learned in this retail environment is that the retailers that survive are ones with good management. Retail itself isn't destined to fail, but bad retailers are. It's very heavily shorted, and at some point there are some structural disadvantages from being a bricks and mortar retailer that it will have to face into. But I wouldn't be shorted if I was one of those investors. It's a really well-run business.
Yeah, I agree. I think from what I was reading when the announcements came out, it was very much around the CEO and the management team and how well they've done. From a personal point of view, I just never shop at JB Hi-Fi. I never even think to shop there. So I'm just sort of thinking,
interesting.
Who's shopping there? And like my first thought is always Amazon. I even go Kogan before I look at JB Hi-Fi online. Like I just never do it. So
yeah, so like I recently got a new phone, and first place I went was JB Hi-Fi and didn't go anywhere else. And when I last bought a TV, it was JB Hi-Fi as well. I wouldn't.
There you go.
I'd maybe buy a TV off Kogan. I guess there's no reason you wouldn't buy it off Amazon, but there are some things that I think a majority of consumers still want to be in the store. They want to ask the questions. They want to, have the remote in their hand or have the phone in their hand or try the speakers out before they buy them. So I don't know. I think you can sort of see them moving away from the model that made them famous, which was heaps of CDs and DVDs sold really cheaply, and into more sort of hardware and equipment. But yeah, I think as long as they just keep moving as the customer moves, I think they're going to be all right.
Nice. Well, we'll see how they perform at their halfway point for FY20. So what have you got, Ren?
So not to have a crack at your first two picks.
Yep.
But I think there's a lot of coverage on some of the big names, and CSL and JB Hi-Fi are probably amongst them. Other companies like Telstra and AMP, Blackmores, you hear a lot in the financial media, other financial podcasts, although you shouldn't be listening to any other financial podcasts. So I've gone for sort of big Australian companies still, but ones that have got less coverage. First one that I had a look at, or that piqued my interest, was News Corp, ASX code NWS. And the reason I found them interesting is just because of the massive disruption that the news business has undergone recently, and specifically print journalism has undergone recently. And News Corp has really suffered on the back of that. Although what we saw this year is they may be slightly turning it around. So revenue up 12% to $10 billion, and they returned to profitability this year after taking a loss in FY18. But what was particularly interesting was their digital subscriptions, so people that are paying for online-only journalism, is rising in a meaningful way in terms of their overall profitability. And they're continuing to see a decline in print subscriptions and advertising. And because of the soft property market, they're seeing a weakness in realestate.com.au. But large rises in digital subscriptions is something that I think is interesting, and it's probably showing that people the world over are realising that they have to pay for content, and that's probably good for companies like News Corp, the Channel 9 Fairfax merged company, New York Times and stuff like that.
Yeah, it's an interesting point. Do you pay for any papers?
Not at the moment. I did for the AFR for a while, but I stopped.
You can get around their firewall.
Recently. No, that doesn't work anymore.
No, but what I mean is if you literally can just sort of copy paste their headline into Google, and sometimes you can get the articles.
Oh, I didn't know that.
You can get around it that way. But if you go through their site, then I think you get a maximum.
Yeah, right. I do think about paying for Financial Times or maybe Bloomberg. I subscribed to The Economist for a while, but I find that I try and, like, because we've got the internet, there's such a varied choice in content. I find it really hard to just stick to one, like pay for Bloomberg and only read at Bloomberg, or, pay for AFR and only read AFR. So, I don't know, there's probably a business challenge in there for someone. The Netflix of news.
Oh, hold on.
$12 a month subscription, and you can get access to 100 articles from each of the major news publications.
Personalised for you.
Yeah, well, it's just like Netflix, the algorithm learns what you want to read.
Because what if there were 100 of rubbish? Oh, I disagree that Netflix learns what I want to watch, but anyway.
Equity, mate.
And anything else you've been watching? And don't feel like you have to do a small one. No hard feelings if you go a big end of town.
Well, Ren, the tact I took was to have a look at a couple of the stocks that we've mentioned in the mastermind sessions with Julia Lee. So I picked out Breville and Media to see how they reported, because both of them had two interesting strategies. So good news is that Breville, we knew that they were on a task and strategy of expanding into Europe, and that seems to be paying dividends, literally. Their revenue increased 17.5% to $760 million, and their dividend increased to 37 CPS as well. So really well done by Breville. They have seen really successful geographic expansion, and they're spending a lot on R&D, which is giving them some good returns in the space. So I'm pretty confident that was a reasonable pick from us, Ren. Now, looking at Media though, I remember we were talking about their transition from traditional sort of billboard to that electronic space using data and that sort of stuff. But they haven't reported yet. They're going to be reporting next week. But what they have done, Ren, is come out and give a market update, because I think their guidance to what they said a few months ago has now changed. And that is because they have seen a significant decline in overall media advertising spend in the second half of FY19. So they have said that in line with the challenging market conditions being experienced by the wider media market, Media advertising bookings for the third quarter of 2019 experienced a sharp decline compared to the bookings on hand at the same time last year. So traditionally, their sales are significantly weighted towards the second half of the year, which is concerning, and they're not going to be seeing that in this second half. So I would imagine that their guidance for FY19 is now significantly less than it was last time they updated the market, and I'm sure if it hasn't already been priced in, then when they do report, we're going to see a bit of a drop for dear old Media. But I thought it was just interesting that less companies, according to them, are spending on advertising at the moment. I'm not sure what that says, but
yeah, so it probably is a symptom of the broader economic pains. We keep hearing about the global slowdown, and I guess outdoor advertising would be something that quickly falls away. If companies are tightening their belts and not feeling confident in the sort of global and economic environment.
So we'll watch out for them when they report next week. Share price movement to be confirmed. Breville, interestingly, is down 16% since reporting on the 15th of August. So despite their solid performance, I don't think it met market expectations. So they've been hurt a little bit. So that's sort of my Australian wrap, Ren. Anything else on your list?
Yeah, I've got three Australian companies. Well, that's it for me. I didn't look overseas for this episode. So do you want me to just go through them, and then you can talk about anything overseas if you want?
Yeah, sure.
So First one, Ansell, ASX code ANN, the rubber products manufacturer. The reason that I found them interesting is they're highly exposed to the trade war. So it was interesting to see how they went in F19 and what their guidance was, because it would have given a pretty strong indication on how this US-China trade war was affecting manufacturers. Ansell has operations in over 50 countries, and a lot of its manufacturing was based out of China. So the F19 results, sales up 0.6%, although if you control for currency, up about 3%, and the adjusted profitability was up about 3% as well. The interesting thing was, though, that so they spoke about the effect of the trade war, and they said it was really hurting, and they were actually moving a lot of their manufacturing out of China as a result. But what the CEO also said was that even without the trade war, they probably were going to move out of China anyway, because Vietnam and Sri Lanka offer 20 to 30% lower manufacturing costs, which is a pretty significant percentage difference if you think about it. And so even without the trade war, if these companies were looking at moving to other Southeast Asian nations, I think that's going to be an interesting trend to watch that will probably get accelerated with the trade war, because that cost differential will be more. You know, if it's 20 to 30% without the tariffs, and now they're trying to sell into America and they have to include the tariffs if they're manufacturing in China as well, it's even more. So, interesting one, just because you can really see the effects of the trade war changing companies' decisions.
Yeah, it is interesting.
Second one that I looked at, or third one, sorry, was the ASX. The ASX itself is listed on the ASX. ASX code ASX, would you believe? I am constantly fascinated by this company because really it's the closest thing to a monopoly in Australia. I mean, there's, I guess, like port operators and stuff are also monopolies, but you know, there are other. There's another stock exchange in Australia, but it's not really a competitor to the ASX. It markets itself to a different type of company, I guess. And you can see the benefits of being a monopoly in the ASX's results. So revenue increased 7.5% to 860 million, and profit increased 10% to 490 million. And if you just think about that for a second, so
wow, what a profit margin.
Yeah, that's where I'm going with this. So net profit of 490 million off revenue of 860 million means that their net margin is 57%.
Wow.
Which is just crazy when you think about it. You know, for context, retailers have net margins in the 3 to 10% range. And then, you know, a good company has sort of 20% you'd be happy with, I guess, depending on the industry. But at 57% margin, that's absurd.
It is absurd. It's an interesting business. What are some of the drivers for revenue? Do you think they would perform better in a bull market or bear market? Is it not correlated?
Yeah, it's a good question. I think the short answer is they would perform better in a bull market. So they make money on activity, and the main activity is new listings. So there's a whole bunch of listing fees that they collect, whether it's an IPO, whether it's a bond issue, whatever it is. And then they would also make money from ongoing activity. So to continue to be listed, every company would have to pay fees to the ASX, and I imagine there would be a whole bunch of companies and banks and stuff paying the ASX for data, and then potentially every trade that goes through the ASX may clip the ticket as well. So
yeah, right.
But you know, if you think about, companies are more likely to do IPOs and to issue bonds when times are good, when the market's strong. So I think they do much better in bull markets. But in saying that, I mean, I just feel that company that has such a strong moat in good times or in bad times. If you want to list in Australia, you're not really going to be listing anywhere else. So
no,
yeah,
I think what's their other competitor, the National
Stock Exchange, the NSX
in Newcastle.
Yeah, it used to be the Newcastle Stock Exchange, not Not a lot of liquidity in that market, you would say?
No.
So, look, I was looking at the ASX's annual report and something piqued my interest. And so I got a little quiz for you.
Love it.
Of the three major categories of assets managed by the ASX, bonds, equities, and futures, which do you think has the highest average value of settlements each day?
Futures.
Correct. Orders of magnitude higher. So $237 billion compared to $56 billion for bonds and $4.6 billion for equities.
Wow.
And I think the futures number is probably a bit of a red herring because a lot of it would be options. And then
Yeah.
if you're not exercising the options, they probably still count into that number, but they're not realised.
Wow, there you go.
But yeah, futures.
Huge money.
Yeah.
Relative anyway.
Yeah, relative to equities. So last one, and this one piqued my interest just because it's an interesting company that when you know about it, it makes a lot of sense that it exists, but it's probably surprising that it exists. InvoCare, ASX code IVC, and what they are Australia's largest funeral provider. And they're a big company. There's a lot of money in death. They fell 8% post their announcement, and that was despite their profit nearly doubling. They increased their net profit by 97%, and yet the share price fell 8%. And so I think
Were the analysts expecting 100%?
yeah. So I think it's a lesson in the importance of analyst expectations, but it's also an important lesson in the importance of guidance. So even though their profit increased 97%, a lot of that increase in profitability wasn't actually due to the performance of the business. Something that I found out while reading this report, a lot of people actually prepay for their funerals while they're still alive.
Yeah.
And similar to insurance companies having a float, this funeral company, InvoCare, has all this money that has been prepaid for funerals that then they go and invest because, otherwise it just sits as cash on their balance sheet. So a lot of the profitability increase was actually driven by the really good performance of the securities that they had invested in. So they were investing really well. And the company actually, their revenue increased 7% in the year. So still not bad, but the 97% increase in profit was not driven by a massive increase in revenue.
Interesting.
But the company came out and said that the F18 had a really weak flu season, and what they meant by that was not enough people died in winter of last year. And the company is hoping that deaths essentially go back to the historical norm, but the guidance wasn't good enough to inspire a lot of confidence in the market because the business wasn't the thing that drove the profitability, rather it was the investments, and because the guidance wasn't particularly strong, the share price fell 8%. My last thought when I was looking at this company was I would have loved to have asked Adam in our ethical investing episode what his thoughts were on InvoCare and where they fell on their ethical-unethical spectrum. Because, on one hand, they provide a necessary service, and if they do it well and they make people's, time of grief more bearable and they, do it in a nice fashion, that's great. But on the other hand, the biggest driver of this company's profitability and what the CEO and the board must be hoping for is that we have a really bad flu season and people haven't been vaccinated and death rates increase. So, I don't know, it's an interesting ethical dilemma, I guess.
We'll have to shoot him an email and ask him.
Yeah. Maybe we can get him back on to do it.
Yeah, it's an interesting one. I think I went to a funeral recently and it was it was just so commercial, huge sort of funeral facility in Sydney, and they were just pumping at funerals out, tens an hour sort of thing, and you could just see the money ticking over. So.
Yeah.
Interesting business. Nice one, Ren. Well, to close out, I've had to duck overseas and I wanted to check in with Disney.
Oh, yeah.
Because one of my favourite stocks of the year, and with the release of some of their biggest, most successful movies ever in the last few months, I wanted to see what impact it had on their third quarter earnings. Unlike Australia, the US are in their period of reporting for their fiscal third quarter. So their shares sunk 5% after the company did miss expectations for both the top and bottom line of its earnings. They blame the disappointing result on the integration of Fox, so it's costing them a lot of money, as well as increased streaming costs and weak attendance at their theme parks, would you believe? So despite having an industry record-breaking year, reaching $8 billion at the global box office, it wasn't good enough for the analysts, and so their stock was hit 5% the day after they reported. But reading through it, Ren, I found an interesting little tidbit. So we know that they're going to be releasing Disney Plus on November 12th around the world, which is going to challenge Netflix streaming service. However, they also announced that at the same time, for their US customers only at this stage, they're going to be releasing another bundle that includes Disney Plus, ESPN, and Hulu, which is another TV and video subscription service, all for $12.99, which is the same cost as Netflix standard subscription plan. So really taking it up to Netflix and giving an offer that's not only your streaming for movies and TV, but throwing in sport as well, which is obviously something that's pretty popular, and one of the reasons that a lot of people sign up to Fox and I guess KO in Australia is to get that service. So they're going to be packaging it all in one. I'm going to be interested to see what effect it has on Netflix and on Disney's, I guess, acquisition of new customer.
Yeah, interesting. It'll be interesting to see what offering ESPN as a streaming service will do to the cable companies in America, like the Foxtel equivalents. You know, once sport's not on that cable channel, I think a lot of people don't see a reason to continue to keep it.
Well, that's, exactly the same. That's how I feel. I mean, now I've got KO and I don't really need free-to-air TV anymore.
Yeah. Nice one. Well, okay, so Disney, it's been one of your favourite stocks. You've been speaking about it a lot this year. It disappoints compared to analyst expectations. So at this point, where's your head at? Are you buying, holding or selling?
Well, I mean, I'm not recommending anything. But,
yeah, true. We can't give advice, so...
Well, I actually do own it, so I'm holding.
Okay.
I still think that there's a lot of upside from them to come. And yeah, I'm very much watch this space, so it's a hold from me.
Okay, nice one.
So, Ren, I think just to close out, for any new listeners to the show, obviously welcome. But as you mentioned when you were discussing some of your companies there's a lot around guidance and expectation when it comes to reporting season, and something we always talk about is that the changes in share price based off the report that's come out doesn't necessarily reflect the underlying performance of the company. So if you are in stocks that have been negatively impacted by a report that has missed guidance, don't panic. It's just an emotional reaction from the market, and things usually will play out back to the way that they should be. So I just wanted to finish with that.
Yeah.
Right?
I think given your poem at the start said earnings season, don't let you lose a long-term attitude on the basis of CEOs' platitudes.
That's
I think
right.
that you're tying it back to that CEOs are going to give guidance to the market to justify their performance or to keep the stock going well in the short term. I think you need to take what the company's saying with a grain of salt and do your own analysis. And, they're not going to be outright lying to the market, but there's always different ways to package the same information to get the response they're looking for out of the market. So, yeah, just test your thesis when earnings come out. Make sure,
Stay calm.
Yeah. If you're... I don't know, let's think of an example that we just talked about. Like, let's say your thesis about Disney is that the new content they're producing gives them a long tail of opportunity to realize that content through video distribution, toys, theme parks, all that stuff. Pull apart their results and have a look at that kind of stuff and see if your thesis is being proven correct or not being proven correct. But yeah, don't react to what the analysts are saying or what the CEO's saying in the media that day. You got to do your own analysis.
Absolutely. Nice, Ren. Well, always good to chat stocks. Exciting time of year. Looking forward to Costa's results coming up. See what impact that has. But until then, we'll leave it there and chat next week.
Yeah, nice one.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity